In 2008, investors across America opened their accounts and saw something strange. Their money was still there, but it suddenly refused to leave. The investment was supposed to be safe and liquid. Instead, it behaved like a Hotel California. Your money could check in, but never leave. The frozen market was worth roughly $300 billion. Overnight, one of Wall Street's quiet corners turned into a financial traffic jam. This crisis centered on a financial product called Auction Rate Securities. Wall Street marketed them like a savings account wearing a tuxedo. The idea sounded clever and perfectly modern. Long-term bonds with interest rates reset through regular auctions every few weeks. Banks described these securities as liquid and dependable. In hindsight, that sales pitch aged about as well as milk in July. Auction rate securities depended on frequent auctions to set interest rates. Investors bid, borrowers waited, and bankers ran the show. If enough buyers appeared, the auction succeeded and trading continued. If not, the auction failed and investors stayed stuck. The market looked stable for years. That stability, however, relied on a quiet little secret. Major banks quietly stepped in to buy securities when auctions struggled. It was financial duct tape holding the whole system together. The biggest institutions ran these auctions. Firms like Citigroup and UBS helped maintain the system. Other giants joined the operation. Merrill Lynch, Morgan Stanley, and Goldman Sachs played key roles. Even Lehman Brothers helped operate auctions before its famous collapse. At the time, few suspected trouble inside the system. Regulators had noticed strange behavior years before the crisis. The auctions looked competitive, but something felt off. One of the loudest voices was New York Attorney General Eliot Spitzer. He began investigating auction practices in 2006. Investigators discovered banks sometimes manipulated auctions. Traders occasionally submitted bids just to prevent failure. That meant demand wasn't always real. Sometimes the banks themselves were propping up the system. Despite warnings, the market kept growing. Investors trusted the big banks and rarely questioned the machinery. By 2007, the market looked calm, polished, and profitable. Investors believed the system worked like clockwork. Billions flowed into auction rate securities from cautious investors. Retirees and universities believed the product was dependable. Hospitals and charities also parked money inside the market. They expected quick access whenever cash was needed. Behind the scenes, however, regulators were growing uneasy. Some auctions looked strangely coordinated. Investigators suspected the auctions were not entirely natural. Demand often appeared exactly when it was needed. Banks sometimes stepped in with their own money to keep auctions alive. Think of it as financial CPR. As long as banks kept bidding, auctions succeeded. Investors saw stability and assumed the market was strong. But stability built on secret support is fragile. Remove the banks and the system faced a serious test. Meanwhile, the broader economy was beginning to wobble. The early tremors of the financial crisis were spreading. Investment banks were already dealing with mortgage losses. Risk departments were quietly tightening the brakes. Soon the banks faced a simple choice: continue supporting auctions or protect their own balance sheets. In early 2008, the banks quietly stepped away, and without their support, the auctions began to fail. By early 2008, the broader financial system was already under stress. Mortgage losses were spreading across Wall Street like bad news at Thanksgiving dinner. Banks suddenly faced enormous losses from collapsing mortgage securities. Risk managers started cutting support for weaker markets. Auction rate securities quietly landed on the chopping block. Supporting auctions suddenly looked expensive and unnecessary. For years, banks had quietly stepped in to buy unsold securities. In February 2008, many simply stopped showing up. Without the banks, auctions began failing across the market. Suddenly, the machine that kept everything moving stopped. Hundreds of auctions failed in just days. Investors who expected quick liquidity discovered their money was stuck. Retirees who believed they owned safe cash investments were suddenly locked out. Their savings were frozen inside the market. Small business owners also depended on the money for payroll and operations. Suddenly, the funds were unavailable. Universities and charities were caught in the same trap. Even hospitals had cash reserves frozen in the auctions. Many investors held millions of dollars in these securities. Selling them suddenly became impossible. Wall Street had sold the securities as safe and liquid. Now the liquidity had disappeared like socks in a dryer. Anger began spreading quickly across the country. Investors demanded answers from the banks. Attention quickly turned toward the banks that sold the securities. Several major firms were now under scrutiny. Investigations focused on firms including UBS and Citigroup. Regulators questioned how the products were marketed. Other firms, including Bank of America and Merrill Lynch, also faced complaints. Investors claimed the risks were never explained. New York Attorney General Andrew Cuomo opened a major investigation. His office began interviewing brokers and investors. Federal regulators also stepped into the investigation. The U.S. Securities and Exchange Commission began examining the market. The industry watchdog Financial Industry Regulatory Authority joined the effort. Wall Street suddenly found itself under a microscope. Investigators discovered troubling internal communications. Some banks had warned traders but not their clients. That revelation angered investors even more. They believed they had been sold a safe product. Across the country, lawsuits began appearing in courtrooms. The quiet bond market had turned into a legal battlefield. For Wall Street, the problem was no longer hidden. The frozen market had become a national scandal. The banks now faced enormous pressure from regulators and investors. The next step would involve billions in repayments. What began as a quiet liquidity problem had become a financial scandal. And the bill for Wall Street was only beginning. By the spring of 2008, the frozen market was impossible to ignore. Thousands of investors were still unable to access their cash. Financial advisors across the country faced uncomfortable conversations. Clients demanded explanations that brokers struggled to provide. Many brokers had trusted the product themselves. Now they were stuck explaining a frozen market they barely understood. Meanwhile, regulators intensified their investigations into Wall Street firms. Subpoenas and interviews began piling up. The investigation led by Andrew Cuomo gathered momentum. Evidence suggested some risks were hidden from clients. Wall Street now faced a difficult question. Would the banks repay investors or fight the accusations in court? By mid-2008, investors had waited months for access to their money. The patience of Wall Street clients was running out fast. Across the United States, lawsuits began appearing in courtrooms. Investors accused banks of misrepresenting the risks. Many lawsuits focused on how brokers sold the securities. Clients said the product was marketed like a cash account. Investigators began interviewing brokers from major banks. The story behind the auctions was becoming clearer. The investigation led by Andrew Cuomo gained national attention. Wall Street executives were suddenly under pressure. Federal regulators joined the effort as well. The U.S. Securities and Exchange Commission launched its own investigation. Public anger toward the banks grew rapidly. Investors believed Wall Street had sold them a broken product. Banks now faced a serious reputation crisis. Their clients suddenly questioned everything they were told. Under pressure, regulators began negotiating settlements. The goal was simple: return investor money. The first major agreement came from UBS. The bank agreed to buy back billions in securities. The buyback reached nearly $19 billion. Investors finally saw a path to recovering their money. Soon other banks followed the same path. Citigroup announced a massive buyback plan. Citigroup agreed to return roughly $7.5 billion. The settlement helped thousands of investors recover funds. Next came action from Merrill Lynch. The firm also faced enormous pressure to compensate investors. Merrill Lynch eventually agreed to a $12 billion buyback. The settlements were among the largest of the crisis. Other firms, including Morgan Stanley, joined the settlements. The total repayments kept growing. Altogether, banks agreed to return more than $60 billion. It became one of the largest investor settlements in history. Yet not everyone received immediate relief. Institutional investors often waited far longer for repayment. After the crisis, the auction rate securities market never recovered. Confidence had vanished almost completely. Municipal borrowers began searching for safer funding options. The old auction system was abandoned. Many issuers switched to traditional bond structures. Others moved to variable rate debt instead. The once enormous market quietly faded away. Few investors wanted to repeat the experience. The collapse revealed a painful lesson for investors. Liquidity can disappear faster than expected. Complex financial products often hide unexpected risks. Understanding them requires more than trust. The auction rate securities crisis remains a cautionary story. Even markets built on trust can fail. For thousands of investors, the experience was unforgettable. Their safest investment suddenly became the least liquid. The market collapse changed how regulators view liquidity. Transparency became a new priority. Investors also learned to question financial promises. A friendly sales pitch was no longer enough. The frozen market of 2008 left a lasting mark on Wall Street. Trust, once broken, takes years to rebuild. For many investors, the lesson was painfully simple. The safest investment is not always the one Wall Street recommends.